Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. During this episode, we will actually discuss tax considerations in private company transactions. So we have the privilege to discuss these issues with a tax accountant and business valuation expert in Franklin and Nashville, Tennessee, Brad Smith. Another way that things are getting done right now, because there are transactions that are happening, things are still happening. Nothing has just stopped, which everybody kind of thought would happen. But let's say the buyer wants to include a seller note in the terms of the sale, and there are tax ramifications to this. But what that really is the seller financing some of the purchase price. So what do we have to deal with if that's included?
Yes, ma'am. I mean, a seller note is actually a very tax-friendly instrument. I refer to it often as an installment note, and it's a means of spreading the tax costs of the transaction over a period of years, potentially. So, I mean, the seller is left generally with a security interest in what they've sold. So that I think is important. And it doesn't really impact the purchase price allocation. It just changes how quickly the seller is going to receive cash and how quickly the seller is going to recognize the tax consequences related to that. Now, I will say there are some ordinary income items that are not qualifying under an installment sale and would have to be recognized in the year of sale. And that's really in the partnership setting. And the tax code will allow the taxpayer to elect to recognize the entire gain if they thought it made sense in the year of sale. So there's some levers that can be pulled for sure, and timing and other factors that's going on in their financial lives will come into play and have to be looked at from a holistic perspective to figure out what makes most sense for them. Another component of a note is an interest factor, right? So the valuation of the sale can actually increase significantly based upon that financing, that interest revenue that the seller is going to obtain over a period of time. So it is ordinary income to the seller, but it's additional value that wasn't contemplated maybe at the time, of the original pricing of the company, and it generates a deduction for the buyer, and perhaps makes the transaction easier to consummate simply because a lender didn't have to get involved that might impose new requirements or restrictions on the whole deal. So they are very common.
It does leave the seller with some additional risk, because if the buyers can't make that company a continued success, there could be issues with paying it back.
Sure.
But I think maybe I've seen some of these happen to, even if you're close to the end of the year, to move some of the purchase into the next year. I mean, so some of it's tax planning.
Absolutely.
Right. So, there are sophisticated ways to try to do some of this.
Yeah.